It is April 13, 2020. It is a Monday, and today I'm pretty excited, not because we had a mildly decent day in the markets, but because I'm going to be going back to education a little bit and start teaching you guys some fun stuff that I like to play with, and hopefully you learn as I learn. So today I'm going to talk about, after I review the account, of course, we're going to talk about delta and what that means. It's an options term. It's not that scary. I'll explain it in the simplest terms possible so you can use it on Robinhood, and have it not be so daunting and having to look at a bunch of charts with a bunch of numbers. And it's very complicated when when I was learning about it. I had to try to make sense of it over a long period of time, but it's actually pretty simple. So well, I mean, I don't know. Simple is relative, but we'll see. So first, the account. All right, here we go. So I'm sitting at 70,000, almost $1,000 higher than last time I made a video. So that's good. Let's see what the big movers were here. The options are doing okay because some of these underlying assets are going down. So that's good. This a call option went up. I'm going to use it as an example later. And then EXK, the silver mining complex and gold mining complex, had a very good days today. I mean, gold is just astronomical right now. It's sitting at 1780 almost. It's pretty crazy. Apple up $532 for me. A lot of big movers actually. Realty income down 238. These numbers are getting bigger and bigger. This aftermarket move here with energy fuel, $725. That's a pretty big move. I'm actually not sure what the news is here on this, so but very, very impressive move here. Moving on, I have energy transfer. Chemical didn't have, it was basically flat, only down $60. But it's good because I have a lot of options sold against chemical, so I'm kind of want it to level off a little bit so I can collect some premium. This is Royal Caribbean. I should have exited these positions a long time ago, I think, but I'll keep them. Same with Norwegian Air ship liners there, cruise liners. This is the former C-SPAN, ATCO, Disney, and you can see the rest of the positions here. Now, how did I do against the market? Well, let's see. 1,000, like let's say $900 would be half of this, so 1.25% on the day. And let's see how the S&P 500 did. Only point. Not what the heck? Oh, because it's up after market. Huh? Anyways, down 0.9, but I guess up 0.4 after market. So definitely beating the market today. I mean, I'm in positive territory and market's in negative. That hasn't happened in a while. And I'm really excited to be actually finally outperforming the market after severe underperformance during the crash there. You can go back in other videos to figure out what I did and what kind of mistakes I made. Okay, now moving on to the more fun educational part. We're going to talk about delta and when you're looking at options. And I mean, what is it? There's a few letters that you got to be aware of, and I'll show you in the Apple's option example right now. But first, let's take a look at this that I've prepared for you. Oops, you can't look at it if I don't switch to browser. So delta is basically the amount your position changes if the underlying asset changes. Okay, so for example, if you have, that didn't happen, if you have a your stock of XYZ go up $100 to $200, if it doubles and your option goes from 100 to 150 in value, then it's said that your delta is 0.5. Okay, that means that it's going to have half the performance of the underlying asset. Now that might sound not right because you know that options are more volatile than equities, than the underlying asset. But you have to understand for what reason, right? It's because you can buy a ton of options in order to leverage up your exposure, right? So what does that mean? Okay, let's go here in Apple, and I'll show you what I'm talking about. Now, Apple is priced at $274 roughly, right? 274. So you would need $27,400, $465 in order to buy 100 shares of Apple. Okay, but if you don't have that $27,000, you can just buy one option of Apple, which is valued at 2,400, right? So roughly 1/10 of the price, and you can get exposure to 100 shares of Apple at the expiration date. Okay, when your option is going to be correlated 1-to-1, basically, with the performance of 100 shares of Apple. Okay, so until then, the correlation is going to be a lot less. So let's click on it so we can see it at another angle, a real life example here. So I have a $300 call for Apple, and if we look at the delta, which is all the way down the bottom, I don't think you can see it on the screen. How do I do this so you can see? Maybe I'll do this. Let's see if I can do this. No, I can't. Oh, you see some Greeks down there. All right, I got it. This is live stuff here, okay? So I'm gonna go unlock this. There we go. You can see the Greeks down at the bottom now. All right, the delta is 0.4475. So that means that right now, today, if Apple goes up, $1, my expected performance of this option is 45 cents roughly. Okay, so that's what that means. Now, if I can revert my let's see if I can fix this now. Okay, good enough, right? Okay, so that's what that means. Now, if XYZ or Apple goes up from $100 to $200, my position would go, and if my position goes the same from 100 to 200, that means my delta is 1. That means it's perfectly correlated with the performance of my underlying asset, which is a stock of Apple. Now, your underlying asset doesn't have to be a stock. It can be something else. It can be like SLV, it can be an ETF, right? It can be some kind of commodity, okay? It can be a house, all right? And you always, delta means you're always measuring something up against something else, okay? So because an option is called, it's a derivative, it derives its value from an underlying option, okay? We relate it to what it's related to, right? So if I buy a call option for Apple, it's related to Apple, okay? So in other words, an option is derivative of Apple. And now I can measure its correlation to that underlying asset, okay? And that's what delta is. Now, delta is affected by time. Okay, so just because my options correlated 4.4 to 1 right now with Apple, right? Meaning Apple goes up $1, my option goes up 40 cents, 45 cents. It doesn't mean that that's going to happen the same way when the option is about to expire, okay? So if the option is about to expire, what happens here is this. I've drawn this graph for you guys here. All right, very thoughtful graph. Now, you can see here that these are months, by the way, on the bottom: January, February, March, April, May, etc. So let's say my option expires in September, right? So the delta of my option will be very stable at first and very low. Okay, so probably, because it's so many months away, it will probably be below 0.5. And then it's going to go towards 1, it's going to cross that 0.5 barrier, go towards 1 as the option is about to expire. okay? Because the difference between buying, 100 shares of Apple today or tomorrow is not going to be that different, okay? So having a 1 day option is not going to be priced that much. It's not going to, it's going to be very correlated versus buying, you know, Apple stocks 10 years from now or like 2 years from now. The price is going to vary. We don't know how much. It could be 100, it could be 1,000. Okay, so because of that time factor, the delta is going to be different. Okay, it's going to take all possible outcomes into account, and it's going to take less of all these possible outcomes into account as time goes on. Right? Does that make sense? Maybe. So that's what delta is. I mean, it's not. I don't think it's that scary. It just tells you the correlation. Now, a really cool thing about delta, I think, all right, is that there is a version for it in a way to measure your portfolio correlation to the S&P 500 index, right? The index that comprises the 500 most valued companies in the States. Now that Greek letter is called beta, and you measure it just the same way, except there isn't this time component, right? It's pretty static, and it's measured every single day. All right, so the you can really find out how much your portfolio is correlated to the market by finding out the beta of each stock, and then summing that up and dividing it by the number of positions you have, and adding those numbers up and dividing it by the number of positions, right? So it's kind of you can figure it out if you got some mathematic, tendencies. But I think it's really cool to find out how correlated you are to the market roughly. Now it's obviously that's it's an expectation. It's not a certainty, right? No one can guarantee that your your portfolio is gonna outperform the stock market if it has a beta of 1.5. All right, you could underperform even, okay, because it may be a specific sector got hit or whatnot. All right, so it's not a guarantee. It just gives you an idea as an investor as to what you're doing, how much risk you're taking in and you're tolerating. Okay. All right. Well, I think that's all I've got to say. Hopefully, you enjoy this and maybe learn something if you didn't know. This is delta, and it's for options. It has a time factor. This time factor is actually called gamma. Okay, gamma is the rate at which the delta changes. All right. So and there's more Greek letters. Maybe I'll tell you about them some other time. But all right. Hopefully that was informative. And these are some things that I'm trying to brush up on and do some calculations and try to figure out my way through these messy times here with these accounts. So if you have any questions, shoot below. And if you actually managed to sit through the video, let's keep the tradition going and to let me know that you've watched all the way through. Type in the comments below the word lamp. All right, lamp. Okay, I'll see y'all probably on Thursday. Peace out.